As we close out the end of the year, one of the major stories of 2024, of course, was the further embrace of crypto, the Bitcoin ETFs, Michael Saylor's financial engineering experiment vaulting him into the NASDAQ 100, and of course, potential policy adoption as the winning political party was aligned with crypto. Now, it's time, though, for a big change on my risk radar. The green for crypto has been there since Bitcoin broke out of its downtrending channel in mid-October. But now, as a high beta asset, it's a binary type trade. It's red time. The light goes red after Microstrategy breaks down technically and Bitcoin's relative strength slows down after its long-term bearish divergence held in place throughout this rally. Firstly, I'll own up to it. Nothing's changed in my view on the underlying asset. But you can't hate me for the coverage. Look at the risk radar throughout the year. The green that I pointed out on October, I think it was 15th or 16th, served you pretty darn well. I overlaid the colors of my risk radar throughout the past year of coverage to exonerate my cynicism, as I still deeply am. I don't think anything has changed with the fundamental utility of BTC. And I don't think much of crypto has changed either. You got $1 billion in fart coin. You got even more in Doge. I mean, this thing is still exactly what it always was. A utility of risk-taking appetite, a barometer of risk-taking appetite. And by the way, that's why the coverage of it has been spot on. Few things I'm more proud of than my Bitcoin coverage, given my underlying doubt about its fundamentals. What prioritizes my coverage here always is what the charts are telling me and what the market logic and analysis is telling me. And what we had was a long period of a downtrend. And that was a very clear channel. Bitcoin's technicals make it a beautiful thing to follow. It's actually kind of low-key my favorite asset class in some ways because of the way it tells us messaging about risk-taking appetite, about how it can tell us the way which wind is blowing for other risk assets like stocks, but also because of its purity in its adherence to technical patterns, which also adds evidence to it being a pure risk asset. What we learned in the selling after the Fed cut here in December is that Bitcoin does trade still as that high-risk asset relative to stocks. But there's a further complication in it this year, of course, which is Microstrategy. This is a company that is financially levered to the gills now on Bitcoin in somewhat of a complex way, but also the simplest of ways. When you're selling debt and selling equity and pushing up your average buying price of Bitcoin to now near like 70,000, I think, Microstrategy becomes the most high beta levered way to play BTC, and that's why I believe the stock price right now is leading the Bitcoin price, because that's what people use all these tools for, is speculation and risk reward. That's the point of the asset class. That's the beauty of BTC, is that it is that risk asset. MicroStrategy's chart is broken down here. I said that I would be keeping the light yellow while it was in a range until we had meaningful lower lows, and that's what we got on MSTR, breaking through 350, 340, and 330. That means it was range bound, and now you have lower lows. The relative strength is also trending lower now for MicroStrategy, and that's an important indicator. Bitcoin and all of the ways to trade it in crypto enjoy momentum more than anything else in the history of investing. You want momentum to generally be increasing always. And when it doesn't, that tells us when the tide can start to turn. The reason why I'm skipping the yellow light from green on crypto into red is because of that binary nature of a high beta asset class. It doesn't really go sideways for too long. It goes up and it goes down. Could MicroStrategy spend some time consolidating, and will it go down without a fight? Yes, it could consolidate, and no, it won't go down without a fight. But the risk now tilts to the downside, and for crypto overall as well. Because the one chart that still itches in the back of my mind that I can't let go, because it doesn't exist anywhere else across any asset classes, is the long-term all-time chart of Bitcoin, which still has a bearish divergence in its RSI. This is going back to the beginning of Bitcoin. You see the lowering peaks, the lower and lower relative strength, even as the price is making higher highs. A bearish divergence technically tells us that momentum is slowing even as price goes up, which means essentially you are getting less return, and your expected return on investment at each successive breakout is lower, and that's what's happened with Bitcoin. The math is very simple. Think about when you go from all the way down there at the very beginning, less than $100 to that first peak. It's a much bigger percentage move than the one from 10 to 100, or the one from 1,000 to 10, or most recently from the break from say 20 to 60 and then 60 to 100. Your percent return and your expected return for Bitcoin goes down the later you get into it, and that's what the bearish divergence tells us. What kind of product has returns directly correlated to how early or late you get in? Something that's only worth what you can sell it to someone else. That's why my fundamental view hasn't changed, but the technicals have been what's driving the coverage, which has been spot on, and now the light goes red. If it gets back above the old range, then it'll go back green, but I don't foresee much sideways action for such a swingy, risky asset class at its most risky ever.